Welcome to a deep dive into the unseen forces reshaping our global economy. Today, we're investigating the silent battle for critical minerals, the foundational elements of our modern world. From the phones in our pockets to the electric vehicles on our roads and the renewable energy powering our grids, these materials are indispensable. Yet, their supply chains are alarmingly fragile, creating an escalating geopolitical and economic challenge. This isn't just about resource scarcity. It's about strategic independence, technological supremacy, and the very fabric of our future.
When we speak of critical minerals, we're referring to elements vital for advanced technologies that face potential supply risks. Think lithium, cobalt, nickel for batteries, rare earth elements for magnets in motors and wind turbines, and copper for almost all electrification. The International Energy Agency projects a sixfold increase in demand for some key minerals by 2040 for the energy transition alone. Current market structures show significant concentration. For instance, over 70% of global cobalt supply originates from the Democratic Republic of Congo. Similarly, China dominates the refining and processing of many critical minerals, creating a bottleneck that has profound implications for global industries.
For consumers, this translates into potential price volatility and availability issues for the products we increasingly rely on. The dream of affordable electric vehicles, for example, hinges directly on the steady and cost-effective supply of battery components. We also see the environmental and social costs of mining increasingly impacting consumer choices, driving demand for ethically sourced goods. Many people are now asking where their gadgets come from and at what cost to the planet and its people. And this heightened awareness adds another layer of complexity to an already strained system.
From an institutional perspective, the scramble for critical minerals is a national security imperative. Governments worldwide are racing to secure these resources through diplomatic agreements, domestic incentives, and strategic partnerships. Recent policy shifts, like the Inflation Reduction Act in the United States, include substantial tax credits tied to domestically sourced or processed critical minerals. Corporations are simultaneously working to de-risk their supply chains, seeking diversification and investing in new exploration projects. The stakes are incredibly high for defense, renewable energy transitions, and the very competitiveness of nations on the global stage.
The current precarious state of critical mineral supply chains isn't a sudden crisis. It's the culmination of decades of evolving geopolitical priorities and economic shifts. For a long time, the extraction and processing of these vital resources were outsourced, often to countries with lower labor costs and less stringent environmental regulations. This led to a highly consolidated market, where a few nations came to dominate key segments of the supply chain. We essentially traded short-term cost efficiencies for long-term strategic vulnerabilities, a decision now coming into stark relief.
The geological reality is that critical minerals are not evenly distributed across the globe. Certain regions are naturally abundant in specific elements, a fact that has always influenced global trade patterns. However, the challenge extends beyond mere extraction. The sophisticated processing and refining capabilities are even more concentrated. For example, China controls roughly 85–90% of global rare earth element processing capacity. This refining monopoly means that even if a new mine opens elsewhere, the raw material often still has to pass through Chinese facilities to become usable. This creates a significant choke point, amplifying risks of supply disruptions, whether due to geopolitical tensions or natural disasters. The capital expenditure for new processing facilities is also immense, with a lengthy lead time before they become operational, further exacerbating the issue.
The human and environmental toll of some critical mineral extraction sites is a significant concern for consumers and advocacy groups alike. Reports from cobalt mines in the DRC, for instance, frequently highlight issues of child labor, unsafe working conditions, and severe environmental degradation. The pursuit of these essential materials often happens in regions with weak governance and desperate populations. This creates a moral dilemma for brands and consumers who want sustainable products but are reliant on problematic supply chains. The push for transparency and ethical sourcing is growing, but real change on the ground remains stubbornly slow.
The lack of diversified investment in new mining projects outside established hubs has created this structural fragility. Mining is a capital-intensive, high-risk endeavor with very long lead times, often 10-15 years from discovery to production. This discourages private investment unless there's strong political stability and clear regulatory frameworks. We've also seen instances where nations, particularly China, have strategically leveraged their dominance in processing to exert geopolitical influence. This weaponization of critical mineral supply chains has forced a dramatic rethink of global industrial policy in Western economies.
As the demand for critical minerals skyrockets, we observe a growing divergence between the institutional responses and the direct impacts felt by consumers. Governments and corporations are enacting sweeping strategies, yet the benefits and costs of these shifts are not evenly distributed. This creates a fascinating and often frustrating dynamic within the global economy.
Data illustrates this divergence clearly, especially in price volatility. Lithium carbonate prices, for example, saw an unprecedented surge in 2022, increasing by over 1,000% in some markets, before correcting sharply in 2023. This whipsaw movement makes long-term planning incredibly difficult for manufacturers and consumers alike. Investment in exploration has picked up, with global non-ferrous exploration budgets increasing by 16% in 2023 to $13.8 billion. However, the vast majority of this funding is still directed towards traditional commodities like copper and gold, with critical minerals only slowly gaining traction. Furthermore, the investment is heavily skewed towards extraction, while the crucial bottleneck of refining capacity still lags significantly. This imbalance in investment creates a structural vulnerability that will persist for the foreseeable future, despite the growing capital deployed.
For the average consumer, this translates into higher prices for everything from smartphones to washing machines, and, most notably, electric vehicles. While governments offer subsidies for EV purchases, the underlying cost pressure from critical mineral prices remains a significant barrier for many families. There's also the burgeoning market for ethically sourced and conflict-free minerals, often at a premium. Consumers are increasingly willing to pay more for transparency, but the options are still limited and often difficult to verify. The repairability and recyclability of electronics are also gaining traction as consumers look for ways to extend product lifespans and reduce reliance on new materials.
Corporations are responding with a multi-pronged strategy to secure their supply chains. We're seeing increased vertical integration, with automotive companies directly investing in mining projects or forming joint ventures. Partnerships with governments are also crucial, securing favorable tax treatments, grants, and infrastructure support for new domestic projects. Companies are heavily investing in supply chain mapping technologies to enhance visibility and identify potential risks and alternative sources. The push for ESG compliance also puts pressure on mining operations to adhere to stricter environmental and social standards. This is not merely altruism, but a strategic move to secure long-term access to capital and meet regulatory requirements.
The global economy stands at a critical juncture, navigating the complex interplay between resource scarcity, geopolitical ambition, and technological innovation. The path forward requires a multifaceted approach, balancing economic growth with environmental responsibility and strategic independence. Understanding these forward macro projections is essential for investors, policymakers, and consumers alike.
While the challenges are immense, technological advancements offer some glimmers of hope. Research into alternative battery chemistries, such as sodium-ion or solid-state batteries, aims to reduce reliance on scarce elements like cobalt and nickel. Significant investments are also flowing into advanced recycling technologies to recover critical minerals from end-of-life products. However, these technologies are still nascent, and scaling them up to meet global demand will take considerable time and capital. Furthermore, the sheer volume of new demand means that recycling alone cannot bridge the supply gap in the short to medium term. The exploration for new mineral deposits, particularly in politically stable regions, continues to be a crucial but slow process.
The concept of a circular economy is gaining significant traction, with consumers playing a vital role. Extended producer responsibility laws and take-back schemes are encouraging manufacturers to design products for longevity and recyclability. Consumer demand for durable goods and repair services can significantly reduce the need for virgin materials. This shift away from a purely linear take, make, dispose model is not just environmentally sound, but economically prudent. Educating consumers about their consumption footprint and the life cycle of their products is becoming increasingly important.
Policymakers are now prioritizing domestic critical mineral production and processing as a matter of national economic security. This involves direct subsidies, loan guarantees, and streamlined permitting processes for new mines and refineries. International collaborations and strategic alliances are also being forged to diversify supply chains away from single dominant sources. Agreements like the Minerals Security Partnership aim to accelerate investment in ethical and sustainable mineral supply chains globally. The long-term economic ramifications include potential shifts in global manufacturing hubs and a re-evaluation of free trade principles versus strategic autonomy. This represents a fundamental reshaping of global resource governance and industrial policy that will define the next few decades.
The global race for critical minerals is more than a commodity story. It's a battle for technological leadership, economic resilience, and a sustainable future. The true cost of our progress now includes the environmental, social, and geopolitical price of securing these indispensable elements. Our collective ability to innovate, cooperate, and adapt will determine who controls tomorrow's economy.